The Holy Grail of smart money trading. If you truly want to win as a trader, then you want to pay close attention. This might be the most valuable trading video you have ever seen. Most people don't know this. What is the real smart money trading? It's not just smart money concepts that every trader is teaching on YouTube. There is a missing piece that 90% of traders don't know. And I'm going to reveal that to you today. With real smart money trading, your main goal is to analyze beliefs and not price when trading. You are not trading against lines. You are trading against people. This is why 90% of traders lose money, because they are not analyzing people's beliefs and they do not know what the number one element is to win in all financial markets. I'm sure you're wondering, how can you do the opposite of what 90% of losing traders are doing and win? The secret is learn the hidden price patterns that reveal the true intentions of the financial markets. The master pattern concepts is the missing link in all of these traders' toolkits. This is the holy grail of smart money trading, whether you know it or not. This hidden pattern right here reveals the true intentions of the financial markets. First, you get the contraction phase, number one, tightening of price. Then phase two is when price expands out of this contraction box. It creates average price line, which is true value. And then it goes into the third phase, which is the trend phase, which is the profit-taking phase. Understanding the three market phases is crucial to your success as a trader. Number one, contraction, expansion, and then the trend phase. Contraction is when you get this tightening of price. Then when price expands out of the box, we get the second phase, the expansion phase, which is a widening of price. Then price goes into the third phase, the trend phase. This is the move to higher or lower prices. These three phases repeat themselves over and over again in every single financial market and on every time frame. Backtest for yourself and you will start to see this pattern. The market is always in one of these three phases. This is how it works. First, we get the uptrend cycle, which is the accumulation. Price goes into phase one, contraction, squeezing of price. It expands out into this whipsaw, which is phase two, the expansion phase. And then it settles above value, where it moves into the third phase, the trend phase, where it moves to higher prices. Then it repeats again in the distribution cycle, which is the downtrend. Goes into phase one, contraction again, this tightening of price, and price expands out into the second phase where we get this whipsaw action. And then it settles below value and moves into the third phase, which is the trend phase, where the market makers drive the price lower, and this is where they take their profits. Pay close attention to your charts, and you will see this cycle happening over and over again. Learning how to follow this pattern in trend is the best way to consistently winning in trading. You put yourself in the optimal points in the existing trend. What is the master pattern concepts? Let me go into more detail. It is the physical, charted manifestation of the mass markets, pain and pleasure driven behavior. These three phases are how you can read pain and pleasure unfolding in the market. This is the only pattern that matters in all financial markets because it directly addresses how money is being transferred based on how traders trade. The golden rule to trading smart: never ever enter a trade until you have accumulated your position from someone who has made a mistake. How do you know when traders have made a mistake? It all starts with defining value. The value line reveals traders' beliefs. It is like a line in the sand in the markets. Value is also known as the contraction phase, which I've discussed in many of my previous videos. It's the future tipping point between bull and bear markets. As you can see, price comes into this tightening, forms a higher low and a low high, which is the contraction zone. We call this the neutral zone. then this is where the value line is extended out of. And this value line is confirmed when price settles into a range between previous high and low points. This value line shows you the crossroad between overbought and oversold markets. When the contraction phase starts, it means buyers and sellers have temporarily agreed on fair market value, which stops the trend. The average price of the contraction area plays forward to forecast market behavior and opportunity. As you can see, we get this contraction zone, we get the value line, and price likes to oscillate around the value until higher time frame players take control of the market and execute the trend phase. This value area over here is organically created through real price activity. This is why it becomes an extremely reliable reference point in the future. More than support and resistance, Fibonacci, this average price line is static and can never be redrawn once the market has confirmed the value area. Once you've confirmed it, it is there for good. As you can see, we get this contraction zone, price breaks out, and below it confirms this value line. These value lines make up the backbone of market structure. Here is an example of a value defined by the blue expansion lines. So over here, this is a 4-hour, we get a higher time frame value line. This becomes our tipping point between bull and bear markets. If price breaks and closes above it with these very strong bullish Heiken-ishi candles, that confirms the trend is happening on the higher time frames. Once we receive this information, we can jump onto a lower time frame and wait for these lower time frame value lines to form. They provide these optimal entry points to hop into the trend and ride it all the way up. As you can see, we would get in at all these price points. Almost shows you with a high level of accuracy these precise entry areas. Listen carefully. How you trade according to average price will determine your skill level. The contraction and expansion is the key to your trading success. Let me explain. We get this contraction phase created here. This is the neutral belief zone. It forms this value line, which is the average price. This is the tipping point of belief. Price breaks above average price line. And this is when dumb money is buying and smart money is selling. Then price breaks below average price. This is when dumb money is selling and smart money is buying. Then price breaks above the line again, settles, and moves into the trend phase. When smart money has accumulated their best positions, that is when price goes into the third phase. Dumb money will always want to buy above the value line and sell below the value line. This is where their beliefs will be tipped. Whereas, on the other hand, smart money is selling above the average price line and buying below the average price line. Smart money is always doing the opposite of dumb money all of the time. This is how smart money is always positioning against the dumb money. Price goes into contraction, the neutral zone. It whipsaws down and up as it breaks above. This is when dumb money is buying positions. And this is where smart money is selling to the dumb money. Then price drops all the way down. It breaks below the value line and dumb money starts to sell. This is where smart money buys. Goes further down and dumb money sells again because they think price is going down. This is when smart money buys from the dumb money. Price goes up, breaks above the value line. Dumb money buys. Smart money sells to the dumb money. Then price breaks below the value line again. Dumb money sells and smart money buys from the dumb money. Price breaks above the line. Dumb money buys and smart money sells to the dumb money. And this process happens over and over again. Here's an example from dumb money's perspective. We've got this neutral zone, the contraction zone. Price breaks below and above, it confirms this value line. As price breaks above, dumb money buys and they place their stop losses here. This becomes the ultimate pain point of the dumb money. Then the market makers reverse the market all the way down, triggers their stop losses, and then they sell their positions to the smart money. It carries on dropping and they think the market's going down and they sell over here. and they place their stop losses up here, which is their ultimate pain point. These become these liquidation areas, and the smart money reverses the market up and it triggers their stop loss where they sell their position. Then price breaks above the value line and dumb money buys again, placing their stop losses down here. And the cycle plays over and over again. This diagram helps you to track the pain points in this master pattern cycle. Whether dumb money is opening a new trade or getting stopped out of an old trade, the same types of orders are being executed at unfavorable prices. In this case, these buy orders are creating favorable demand for smart money to sell to. It is basically making the wrong transaction at the wrong price level consistently. By understanding the role of dumb money and smart money and how they interact, it can create a mental framework in your mind to be able to have a structured approach to enter the market at the right places. Understanding this pattern shows you the entry points that have the least probability of putting you in pain.